Welcome to Wisdom Well, fellow truth seekers, to a thought-provoking journey into the heart of America's financial landscape. Today, we're uncovering the real reasons behind America's looming bankruptcy. Strap in as we expose the hidden factors, delve into the shocking statistics, and challenge the narratives that paint a different picture. This is not your typical financial analysis. It's an exploration of the underlying forces that could shape our nation's destiny. So, if you're ready to dive deep into the labyrinth of economic complexities, join us as we embark on this eye-opening quest. Get ready to question everything you thought you knew about America's financial future. When you browse the news, you'll undoubtedly come across headlines proclaiming that the US is teetering on the edge of a recession, with warnings of a potential debt default that could lead to the collapse of the dollar and the bursting of the everything bubble. Even the S&P 500 recognizes that this scenario is looming. And, interestingly, there's a new Starbucks drink causing quite a stir, quite literally, by unexpectedly prompting frequent trips to the bathroom. While it's true that negative headlines tend to generate more online engagement, it doesn't mean we should disregard the genuine concern surrounding our decelerating economy. As the deadline for the debt ceiling approaches, Warren Buffett's decision to sell stocks and his cautionary statements indicate that the remarkable phase of growth for the US economy may be reaching its conclusion. I believed it would be valuable to refute these assertions and explore the most recent insights on inflation, along with strategies to capitalize on future developments. So, without further ado, let's delve into the subject. To gain a clear understanding of the situation, let's examine inflation, which has emerged as a pivotal indicator for our economy. Higher inflation necessitates elevated rates and can result in the diminishing value of stocks and housing. However, we must question whether inflation is truly subsiding. While the Consumer Price Index, or CPI, serves as the primary gauge of inflation, it may not be entirely precise due to the inclusion of volatile items with fluctuating prices. To address this issue, the core inflation measure excludes food and energy, which are recognized for their volatility. Presently, the inflation landscape presents a combination of positive and negative development. Inflation has fallen below expectations and is currently below 5%, making the first time since 2021. As a result, if inflation maintains its current trajectory, it is anticipated to remain below 5% in the upcoming year. This decline can be attributed to reduced expenses in fuel, energy, and transportation. However, certain items experienced notable price hikes, such as used cars and housing. Food prices witnessed a substantial increase, with cereals and baking products surging by an astonishing 12.4%. Additionally, dining out, including restaurant meals, saw an uptick of 8.6%. Consequently, the impact of inflation may be more pronounced than what the report initially indicates. Core inflation, which excludes food and energy, remains steady at a rate of 5.5% year over year. Despite the swift rise in interest rates, this resilience in core inflation suggests that rates may need to be sustained at elevated levels for an extended period. Housing continues to be the primary driver of inflation, with housing-related expenses witnessing an 8.1% increase in April. Nevertheless, it is essential to recognize that this data represents past costs rather than present market conditions. As rents begin to decrease, there is a possibility that these figures will decline later in the year. Additionally, it's worth highlighting that Jerome Powell is contemplating the concept of supercore inflation, which omits housing from the calculation. By eliminating elements that contribute to elevated inflation, the overall perspective becomes more favorable. The debt ceiling represents a significant concern that impacts multiple facets of the economy, including stock prices, interest rates, and housing prices. If the United States reaches the debt ceiling, it faces a crucial decision: either agree on a new limit or face the possibility of a government shutdown on potential default on its outstanding debts. The U.S. Treasury Secretary has issued a warning about the imminent possibility of the country running out of funds. While raising the debt ceiling has been a routine practice in the past, the current situation appears distinct as both sides face challenges in reaching a consensus. While the prospect of defaulting on debt is a grave concern, it is improbable due to the severe consequences it would entail. Nevertheless, the impasse surrounding the debt ceiling can have adverse effects on the economy, including a potential decline of almost 20% in stock prices, a contraction of over 4%, and subsequent job losses. It is crucial to take into account the noteworthy remarks made by Warren Buffett. His substantial stock sell-off, amounting to billions of dollars, suggests his belief that the remarkable era for the U.S. economy is drawing to a close. Furthermore, concerns surrounding China, the banking sector, and commercial real estate have the potential to influence the overall state of the economy. Moreover, the discrepancy in performance between the top 10 stocks and other companies raises apprehensions regarding the overall strength of the market. Despite the market's present anticipation of a pause in interest rate hikes by the Federal Reserve, high-income households are encountering a slowdown in wage growth. Consequently, it becomes crucial to manage expectations for the market in the upcoming years and prioritize key strategies such as diversification, establishing a reliable income source, and maintaining an emergency fund. To sum up, exercising caution and maintaining a well-rounded portfolio is essential when confronting potential economic hurdles. By managing expectations and ensuring sufficient cash reserves for unforeseen circumstances, you can establish a stronger long-term financial standing. For more beginner-friendly investing videos, be sure to check out the content in our channel Wisdom Will. And if you're new to the channel, don't forget to subscribe for new videos every week. And there you have it. Please share any advice, good stories, or inquiries you may have regarding this video in the comments section below. I'm Wisdom Will. Thanks for watching this video, and see you again next time. Have a great day.